Friends, in this video for ithought Advisor, I am going to talk to you on the topic ETF versus mutual funds, the art of choosing. Whenever I see people talk about ETFs, they always position it as something superior to mutual funds. Look closer and see what are the facts that are being marshaled in support of ETFs, and you will come back again and again to only one major factor, that is cost. I have no problem with that. It's an established fact. But the way I have seen ETFs or experienced or used them is not because I saw cost as the advantage. I always saw benefits out of ETFs which far outweigh the cost benefit. The benefits which costs give us is very marginal compared to the benefit of choice, the benefit of diversity, the benefit of convenience, the benefit of very specific opportunities, and the benefit of superior returns. These are things which ETFs can do provided we apply ourselves correctly in them. So, an ETF doesn't do wonders on its own. It's not an investment product which succeeds on autopilot, but it can be a very powerful investment tool in the hands of an investor who is discerning and wanting to do something different. Contrarian investors will love ETFs. Investors who go against the trend will find them very convenient. And investors who want to be ahead of the curve will be able to use the ETF to control their investment actions very well, especially if the cycle extends a downtrend longer than they anticipated. So you will be having an adequate response to a longer downtrend where prices go lower than you expected or stay longer at the lows than you anticipated. The ETF brings all these benefits. It's not as if the mutual fund schemes don't bring these benefits. They do have a lot of these benefits overlapping, but some of the equity mutual fund products which are sectoral are priced way higher than an ETF. Also, when you go and invest globally, I find that some of the specialty ETFs are priced higher than what we would normally accept. So, pricing is a function of what the product can offer to its customers and how much cost the market is willing to pay. So, if you are putting up a semiconductor ETF or something which is unique, people may be willing to pay slightly better. So, pricing is not really a big worry. So, these narratives which are peddled by people on social media that ETF is cheaper, it saves you cost, you can invest in it and you can win, is in my view very reductionist. It's a very narrow way of thinking through opportunity. I would rather think through opportunities in a more broad way. I'll tell you how. For example, I expected that there will be a PSU trade. I was extremely early on the trade. But I found that investing through a Bharat 22 or a CPSE ETF or a PSU bank ETF would provide a way superior opportunity to invest in companies than a mid-cap fund or a small-cap fund would. So, the comparison was not between one set of ETFs and mutual funds addressing the same need. On the other hand, I also felt that some of the PSU funds, thematic funds investing only in PSUs, were a better option at different points in time to do lump sum investments, and they delivered better returns when those opportunities were invested into. they did better than the ETFs. So there are both sides to the argument, and it's not as if ETFs are always superior or mutual funds are always superior. Depending upon the valuation, the composition of the portfolio, the opportunity, and the preciseness of an investment advice, it is possible to get superior returns out of both type of investments. So as an investor, I think there is no merit in having these biases about ETFs versus mutual funds, how one will always be consistently better than the other. One can't say that. At different points in time, different portfolios have better prospects, and a ETF portfolio will have better prospects only in a particular context because it is more or less a static portfolio. The fund doesn't see many changes, composition is stable, whereas a mutual fund portfolio is a dynamic portfolio where the fund manager keeps changing his portfolio according to opportunity, awareness, level of choice and preference. An ETF fund manager doesn't have any of these. He has to stick to a formulaic product in which you are free to invest more when opportunity is favoring you. So an investor's role in an ETF is actually higher. You need to do far more heavy lifting. You need to be a contrarian. You need to buy. You need to buy when others are not willing to buy. And you need to scale up under very adverse circumstances. If you do these things, your portfolio will get superior investment performance simply because you chose ETFs. And when it comes to mutual funds, it's exactly these traits that you need to bring into play with a sharper focus on where the portfolio is heading, because the mutual fund portfolio is dynamic and prone to regular change, whereas the ETF portfolio is not really prone to such dynamic change. It's relatively more stable. Knowing these things is very, very relevant because that will help us overcome biases we have in our minds about ETFs, about the relative attractiveness of an ETF over a mutual fund and the superiority of one product over the other. According to me, both products are needed. One product could do very well in a particular context, other product could do very well in a different context. It's very important that investors use both products on merit and bring them into your portfolio whenever you need them and get performance by capturing it when it presents itself before you. Thank you for watching this video.